Good to have you with us. Thanks for tuning into Mirror Now. Welcome to another episode of Investor's Guide, where we help you understand all about saving, investing, and how to make your money work for you. And of course, you can get all of your personal finance-related questions directly answered by the experts. So whatever your question, do send them in. You can email your questions to us on investorsguidemrn@gmail.com. You can call us on 02224990546 or simply connect with us on Facebook or Twitter. The details of how you can connect with us all flashing on your screen. So on today's show, joining me is Kartik Jhaveri, Certified Financial Planner, to answer all of your questions. Kartik, thanks so much for joining us today.
Pleasure.
But before we get to answering all your questions, let's tell you about the big announcement that came in a big boost for our economy. The Finance Minister today slashed corporate tax rates for domestic companies. From paying a tax of anywhere between 30 to 35%, companies will now only pay a tax of 25%. In fact, a bigger boost for new manufacturing companies was also announced. New manufacturers will have to pay only a 17% tax rate, practically cutting their tax burden into half. Now, this move is being viewed as the big bang reform that was needed to boost the economy, to improve consumer sentiment and to boost demand. Essentially, what this means is it means a lower tax burden on companies, which means more money in their hands. So companies will be able to spend more, they'll be able to invest more, cut product prices if they want to boost demand, and perhaps even be able to create more jobs. And all of this is really important when we talk about a turnaround in the economy, or when we talk about boosting the economy given the current economic slowdown that we are in. But of course, as a result of all of this, the stock markets today zoomed. The Sensex closed almost 1,900 points higher, while the Nifty closed 570 points higher. So the big question right now is, what does this spike mean for your investments? And should you be making any changes to your portfolio, and how should you approach your investments at this stage? So let's bring in Kartik here. Kartik, let's start with this. In fact, we've seen, last few weeks, several weeks, we've been getting a lot of questions about, how the markets are down, how the investments are suffering, whether one should pull out and stop SIPs. And now we've seen this big jump coming in today, which is obviously going to impact everybody's investments. What's your first reaction and first, advice?
Continue your business as usual. That's my first advice and the last advice, actually. So when it comes to investments, there are such days that happen every few years where these are like game changer days, where so many months or years of turmoil and pain and suffering is suddenly just erased. And there are also days where, there's going to be so much of pain and suffering that it'll linger for many months and years also. So this is how the stock market works. There is exuberance on the positive side as well as on the negative side. So you should do what you are supposed to do. We should keep investing consistently, constantly, in a disciplined fashion. If you're doing an SIP, don't stop your SIPs because you're not doing it based on a 1 year or 2 year or a 3 year performance, or even a 1, 2 or 3 year history. And in the same way, if you're doing lump sum investments, again, break your investments. The standard operating principles remain exactly the same always and forever. So nothing is really very different, but this kind of moves should also reassure all the skeptics that there are times where times are bad, but then there are obviously measures that are announced either by the government or otherwise sentiment improves, things change, and as a result of which, the cycle turns around and you do make profits if you've been nursing losses for a while. And this is how the stock market creates that 15, 20, 25% of growth for you over the years to come. So I think one should be really reassured, if at all, and otherwise just continue business as usual.
Yes, absolutely, Kartik. In fact, this is also a very good time to explain to viewers, especially to first-time investors, what it means to continuously do SIPs and why it's important to do SIPs, so that when the markets do go up like this, which can have a huge impact on your investments, you get the benefit of it instead of trying to time, because obviously nobody can time when a good day is going to happen or when a bad day is going to happen. So by investing regularly every month, it's exactly such days to make use of how that really benefits you.
Yes, I agree. But it's not only these days. You see, what happens is over a period of time, it's like growth happens in chunks. Growth does not happen in a linear fashion all the time. So all businesses go through some sort of a period of great growth, mediocre growth, stagnancy. Maybe then the capital of that company will get reallocated. They will think about reinvesting additional funds into it, and again there will be great growth, and then mediocre growth, and then again stagnancy. So these kind of cycles keep repeating, whether it's the banking industry or engineering industry or the pharmaceutical industry. It all happens from time to time, which is why we keep recommending that, if you're an investor who's making money based on monthly contributions to the stock market, which is through the SIP route, then constantly keep doing so, because you're not doing it for a year or 2 or 3. You're technically doing it for as much as 10 to 15 to 20 years. Just the way you pay your insurance premiums for 25 years, pretty much the larger part of your working life. This is an investment that you're doing for your own wealth creation, and why should that happen for a year or 2 or 3? That should also happen for a larger part of your working life. So just exactly in the same way, that investor who is absolutely disciplined is the one who makes the maximum wealth over a period of times.
Well, absolutely. In fact, let's now quickly shift focus to all the queries that we've been getting. First query comes in from Dr. Sudhakar, who says, I'm 50 with 2 children. I have invested in mutual funds for the last 10 years. Please suggest if I need to make any changes to my portfolio. And he's listed out his portfolio, got ICICI Pru Blue Chip Fund, Birla Sun Life Frontline Equity, L&T Value Fund, Canara Robeco Emerging Equities, Mirai Asset Emerging Blue Chip. I also have 2 funds, Reliance Small Cap and Principal Emerging Blue Chip Fund, which are not doing well. And so I've stopped doing the SIPs and planning to move out from these 2 funds. So Kartik, what would be your advice here? Again, as far as 2 of the funds are concerned, he's taken a call to stop SIPs in them.
So this is very clear. This Dr. Sudhakar apparently seems to be doing investments management on his own. Because if he had got some professional advice, then those advisors would have told him to not stop. These funds are great funds. They have been performing exceptionally well. And see, when an investor, or when you as an individual, if you're doing it yourself especially, when you're looking at things, don't just look at the last 1 year or 6-month performance. This is not like a cash machine, or this is not like a casino which has got a guaranteed flow, where you press the button and you put your investment in and you're going to get some return out of it. That only happens in a bank fixed deposit, that you are sure that when you put your money, you are going to get X amount of return in a 1 month, 3 month, 6 month and 12-month period. So you're investing into a business, and which is why it's very important to understand how a business works, and which is why it's great to consult. It's a good idea to consult a professional. But having said that, I don't think you should have stopped your SIPs anyways, and this is the exact behavior where you lose out on these kind of good days. Now, what a day to talk about. Today, the markets are up about 5%. In one day, your net worth could have gone up by 5%. Now, that's a huge, and in a whole year, you get 365 days you have to be invested to get a 7% in a fixed deposit. That performance, almost that kind of performance has happened in one day. Individual stocks have gone up anywhere from 7% to 14 or 15%. See the kind of exuberance and a great recapture of all the losses of the past that has happened. I think people would do well to be invested. None of your schemes are bad, but if you remember, if you have to make money and through the SIP route, it's got to be for a minimum period of 10 to 15 years, and you take professional counsel if you're really going to stop an investment. I think these funds that you've stopped shouldn't have been stopped.
All right, well, that's the advice coming in, Dr. Sudhakar. Hope you've made note of it. Next question comes in from Quentin Fernandez, who says, I have 2 lakhs each invested in Aditya Birla Small Cap Fund and L&T Emerging Business Fund. Both funds were doing well, but in the last year have just gone down. Both funds combined, I'm at a loss of 1 lakh. Should I stay invested in the hope that they will pick up and do well, or should I exit and reinvest into a better performing fund? Well, Kartik, of course, this is exactly the kind of question that we've been getting a lot of late. People wondering whether they should exit their funds. Also, if you could answer that question and then also explain to our viewers when should one actually look at exiting a fund? What are the key highlights or parameters that one should look at?
Okay. Let's talk about the funds first that he's asked for. So, funds are doing bad. Why are they doing bad? Because it's a small cap fund, and the other one is an emerging businesses fund, which is again, a fund that is likely to explore new opportunities, as the name says. Now, in both these kind of situations, if the stock market is going to go down, then individual stocks tend to go down even further. And as a result of that, you're seeing bad performance and you're quite disappointed about it and you want to get out. But again, just like we've been reiterating this point today, the longer you stay, the more you will make. And you cannot be so timid and so nervous and get out of it. Because if fundamentally you are not prepared to see a fluctuation of a 10 or 20% negative on your portfolio, then I do not think that anybody even deserves to make 30% and 40% and 80%, which the stock market does produce for you over a period of time. Again, I think it's a question of education and understanding and a good counsel. Having said this, when you invest into the stock market, your minimum guideline period that you need to be invested is at least 4 to 7 years, because it takes that much time for a business cycle to turn. Now, when you are investing, when you are entering, you don't know exactly what's the time. It could be the bottom of a cycle and the cycle is just about to turn, or you could be in the middle, or you could be at the top. One doesn't know that. Nobody can really predict that. But therefore, understand that there is a time factor which will play out for you. And then when do you really sell out? Make a plan when you really need it. So if you're going to need it after 8 years or 10 years or 12 years, then maybe that's the time you will pull it out. And if your fund value has already been achieved, if your target has been achieved maybe a year in advance, by all means pull it out and park it in a fixed deposit there.
Right, absolutely, Kartik. Just one more point. So when do you decide that the fund is really underperforming and perhaps there are other funds which would be performing better where I should be investing in? When do you take that call versus the discipline of staying invested despite the fund's up and downs?
So what happens here is there is no single leader all the time. It's a good idea if you keep checking and analysis and do an analysis every 6 months for the category that you're invested in. Now, if you see that your investment falls within the top 20 investments or top 20 instruments in that category, then I think you are reasonably okay. Because even when you are saying top 20, the topmost person and the 20th ranked fund or a 20th ranked investment could have a difference of not more than 1 or 2% on a 10-year basis, which is not a lot if you think about it. So therefore, I think it's a good idea to keep checking. Now, if you find that your investment has consistently been a laggard, it's right at the bottom, it's actually gone out of the list and the fund managers are not doing a great job, and if that consistently happens over a 3 or 4 year period, then maybe that's the time to think about changing it. But you've got to give it some time. You got to even give patience. Maybe the fund manager has a strategy and it's going to take time to play it out. So you cannot be really timid and say 6 months, bad performance, press the button, you're out. That doesn't work.
Yes, absolutely. Well, the next question comes in from Baswaraj Bhima Reddy from Hospet. He says, I'm 59 and I'm retiring next year. I have invested in HDFC Equity and HDFC Top 100 since 2015. Via SIP, but when both funds started giving negative returns, I stopped my SIPs. I have accumulated 20 lakhs in both funds. I've now started investing in HDFC Capital Builder and HDFC Mid Cap funds. In both, I've been investing 5,000 rupees. Request for advice on what I should do. Kartik, here's somebody else who has decided to stop SIPs despite both the funds being quite good, in fact.
Yeah, absolutely. So when you stop, and I think the advisor doesn't have too much of a decision to say, or maybe he didn't consult, or maybe the advisor's advice was not paid attention to. Because what happens is sometimes these kind of situations are normal. So when you invest for 2 years, you don't get returns, or 3 years and SIPs have produced no returns, then there's pressure on yourself, and as well as there's pressure on the financial advisor that you might sometimes put. And the advisor might say, okay, now, go to another fund and in the same stable of funds. So maybe all the choices are great. I don't have a problem with any of the choices. But I think patience, patience is a great virtue, and I don't think anybody without the virtue of patience really will be rewarded in the stock market. The stock market is a long waiting game. Sometimes it's a frustrating wait, and it could be 2 years and 3 years and 4 years. Not just because of today. If you exclude today, and if you just sort of put today's day, if you just sort of hide today's day in history, you might be in a very gloomy and a very bad situation. Suddenly the mood has changed today. Who knows what's going to happen on Monday? Maybe we'll be back to square one. Taxes have been slashed today. Corporate taxes have gone. have been down, which is a fundamentally great reform. We are going to have a lot of companies who will have a lot of money saved, and therefore more money to invest and more money to deploy into machinery and plants and more development work, more employment, so on and so forth. But that doesn't necessarily mean that the consumer has enough money to go out and start buying everything, because the consumer is a different entity and he's still earning what he's earning. Doesn't mean he's going to get salary jumps, and doesn't mean that profits are going to go up for each and every person in the ecosystem that we have. So we'll have to see. But basically, patience is the virtue.
Yes, that's absolutely true. In fact, the next question comes in from Anand Nyayapati, who says, I've invested in HDFC Young Star Super Premium Plan, annual premium of 1.2 lakhs. The total fund value in April 2019 touched a peak of 11.9 lakhs, but post that it has been steadily declining, and currently it's at 1.07 lakhs. I've lost more than 1 lakh in 5 months. I've stayed invested in this fund for about 6 years now, and there is still 4 more years to go. Please let me if I should continue or should I close this and come out of this? Given the economic situation in India and around the world, I don't believe that this is going to turn around any sooner, and I'm afraid I will lose my existing fund also. Well, Kartik, I mean, his fear perhaps may be right, because he's in 5 months, he's lost 1 lakh and still has some more time before he can actually, before the entire amount, the policy matures really. But what's your advice?
Well, that's nothing, because from a 11 or 12 lakh, if you have a 10% fall, you're going to lose a lakh. So what's the big deal about it? I mean, like we said, 10-20% fluctuation should be expected in the market at any point of time. But I think there's a little bit of confusion on Anand. You see, he talks about a fund, and then he talks about SIPs, and then he talks about premium. So of course he's invested in a ULIP.
Yes.
So most of these ULIPs until about last year. Now ULIPs have also undergone a dramatic shift in their design and features, but until all the ULIPs of 2016 and before, most of these ULIPs were pretty expensive on the cost and all of that. So which is why you obviously were not making enough money to begin with. But then over a period of time, it catches up, and now that it catches up, why would you need to worry? Stay invested in equity portion. Don't feel very nervous about the whole thing. It's a stock market fluctuation. By the time you send us your question, you were 5 or 10% down. Maybe today you recovered 5% of that. So you don't need to worry so much about it. You got 4 years to go. Continue your policy. It's a policy, so continue the policy. And whatever damage had to be done is already done. And now you're only going to look at positive returns for the years to come. Stay invested in equity. Do not shift your money from equity. Do not allocate it towards bonds. There is a lot of wealth that will get created in India over the last, over the next so many years. So it has happened in the past, last 10-15 years. It's going to happen again. So don't get nervous.
Absolutely. In fact, next question comes in from Dinesh Singh. Says, I'm a new investor. I started with an SIP of 2,000 rupees in SBI Hybrid Equity Fund. I can save 10,000 rupees monthly, and I have a horizon of almost 15 to 20 years. I want to invest for my children's future. Well, clear financial goal, clear time horizon. Kartik,
Yes.
What's your advice?
Yeah, so I mean, it's great. So we'll just tell him the numbers that he can expect. So, if you're going to invest for 20 years and about 10,000 rupees that you're planning to do on a long-term VC of 15 to 18% return generation, that is quite easily possible. In fact, the index does it. So a fund is likely to do even more. And you can look at about 1.5 to 2 crores of wealth generation in this much of a time period. So you've got a lot of time in your hand. Now, hybrid funds, I'm not very excited about it, considering your situation, you see, because you have a clear-cut time frame, you have a clear-cut goal, you know why you're doing this thing. So why are you then going into a 65%, 35% kind of a product? Why not go into a 100% equity product and, try and take advantage of the 15-20% returns that you're going to accumulate in this product over a period of time? Why go into a slightly conservative second level strategy? You're not really in the phase of life where you're trying to protect money. You want to grow money, you want to multiply it. So if you want to multiply it, go for it. Go to equities and enjoy the wealth creation in the process that you're going to see.
Right. All right. Next question comes from Ankur. Says, I'm 38 years old. My investment horizon for my 2 children is 10 to 15 years. I'm investing 3,000 rupees in a balanced fund and a mid-cap fund. I'm planning to invest an additional 8,000. Which fund categories should I invest in? Do I need to include debt funds? Again here, Kartik, a long-term horizon, and he's investing in balanced funds. Because
see, a lot of times there are mixed messages that really come out, and which is why I think this education is so important. Everyone's situation is different. So when you get a general advice that you read on a blog or you even see it on television, the advice will be a general advice. Put some money in equity, put some money in bonds, put some money in gold. But now, because we have a question, we are answering that question. Therefore, it's a good idea sometimes to customize answers to your real requirement, and that's something that you will get outside through a lot of professionally qualified people. Now, having said that, my idea is don't go into debt at all, because it's clear you want to create wealth. So if you want to create wealth, why are you going into a reverse mode and trying to protect your wealth? Look at large cap funds, which you must include in your portfolio, about 30 to 40%. Look at mid cap and small caps, which should constitute the bulk of your portfolio. Again, about 40%, 20% into each of them. And even if you consider some sectors which are good, and some sectors like banking and finance, things like that, I think that becomes a very, very robust portfolio, and there is very little duplication in your portfolio. Now, that kind of a portfolio, 11,000 a month, and if you're going to do that for about 15 years, average return of 15%, I think you can easily accumulate about 75 odd lakhs. So I don't think there's a problem with that kind of wealth creation. It'll happen, but you can sort of spread your investments and don't go conservative.
Right. Well, similar question. In fact, another question that takes over from that comes in from Divyesh Kotecha, who says, how long should one remain invested in equity mutual funds? Kartik, quick thumb rule at least.
There's just one word for this answer: forever. You stay invested forever. If you need the money, you pull it out. If you don't need the money, let the wealth multiply. If you don't need the money, leave a legacy. You can do so much. It's an open-ended investment. There is no such time frame. There is no compulsion for you to come out. What's the worst that can happen? A 20%, 25% downswing in a volatile scenario. So you will see 25% downs also, and you will see 25% ups and 50% ups also. And keep invested for 20 years, and you will never be even in a single digit. You will always be in double-digit returns. So the answer is simple: forever.
All right. Well, we've got a caller on the phone line. Krishna calling us from New Delhi. Hi, Krishna. Thanks for calling in. Go ahead. What's your question?
I'm a senior citizen.
Yes.
And I am retired from a semi-government organization.
Okay.
I want to invest for maybe for 3 to 5 years, so I can get a regular return, monthly return, or a quarterly return.
Okay.
So could you suggest me the best?
Right. Do you have already any investments made?
Yes.
Okay.
And, the maximum limit of 15 lakhs, which I have already in the post office.
Okay. Okay. All right. Kartik, over to you. What would be your advice?
So once you've expired that limit of 15 lakhs already, your next best convenient option is the fixed deposit in a bank, which does the job for you. You want slightly better returns than corporate deposits are, which are AA and AAA rated kind of corporate deposits. That's an investment area that you can consider. And if you want something even better, and if you don't mind a 1 or 2% capital fluctuation, then I think you can even consider perpetual bonds, but then the ticket size is larger. Ticket size for perpetual bonds could be at least about 10 lakhs, 20 lakhs, 30 lakhs, because that's the tranches in which it's traded. But then you get about 9%, 9.5%. And these are bonds from PSU banks, as well as AAA rated and corporates, good corporates, as well as from state governments, which are obviously backed by the sovereign. So there are lots of options for you, even ranging from about 6% to about 9.5%. So there's a lot of variety for you even today.
All right, Ms. Krishna, hope you got that, noted that down. That's the advice coming in from Kartik. We've got, I think, time for one more question, Kartik. It comes, in fact, this question has come in from a couple of people, Venus John, Saurabh Sauni. I think last time round, you had given out some numbers and a calculation, which they all wanted more clarity on, saying that Mr. Kartik suggested that 10,000 invested today will amount to 2 crore after 20 years. Could you please elaborate on the calculations? Go ahead.
It's very simple. Future value formula of Excel, 10,000 every month, done for 20 years, growth rate approximately 16-17% becomes 2 crores. So it's easy. I mean, these numbers are difficult to digest because, you can be a skeptic forever. So the only way to solve it is either you educate yourself really well, and which is, I think, a really, really crucial part of our education system, that everybody learns a little bit about money. And while the schooling systems doesn't give it to you, then you have no choice but to do it yourself and independently. And there are so many websites, there's so many tools, there's so many free calculators that help you do that. even our simple Excel, which is there in everyone's computer, you just say 100 rupees, future value. It'll ask you whether you want to do it on a single investment basis or a monthly investment basis. So you just say it's a monthly investment. 10,000 monthly investment, you do it over a long period of time. I mean, it's 20 years that we're talking about. So essentially, you would have invested 24 lakhs over a 20-year period, and that becomes about 2 crores. 16-17% is the index return. In slightly better times, about 13-14% is the index return in not so good times. But as an average, 15 to 20% is what we speak. So this is somewhere in the middle.
Yes, absolutely. And this is the principle that SIPs work on, and
Absolutely,
why we keep sort of reiterating the importance of putting in a few thousand rupees every month, and that can actually result in crores at the end of a long-term period like 15 to 20 years. And just for our viewers, do go ahead and Google the power of compounding to understand what it really means and how it can actually add value. There are calculators, so punch in your own numbers and you'll actually see how much you can get at the end of a 10, 15, 20-year period. Absolutely.
You'll be amazed.
All right, well, on that note, it's time to wrap up this edition of Investor's Guide. Thanks so much for watching. Keep sending us your questions. We'll continue to take them on the show next week. Until then, happy investing.